Most people believe that when a payment goes through, the system has accepted it. The card works. The transfer completes. The message appears. Approved. But approval in modern finance does not mean ownership. And it does not mean permanence. It means something much quieter. It means the system has allowed the transaction. For now, if money in your account truly belongs to you, why does the system need to approve it every time you try to use it? If financial access is guaranteed, why does every transaction pass through a network that can stop it? And if approval is required today, what exactly guarantees that approval tomorrow? These questions are rarely asked because most of the time, the system works smoothly. Payments are processed instantly. Transfers settle within seconds. Digital balances appear stable and permanent. But beneath this smooth surface lies a financial infrastructure built around authorization, monitoring, and institutional control. Modern money does not simply move. It is allowed to move. Understanding this requires stepping away from the everyday experience of banking and looking at the deeper structure of the financial system itself. Most people experience money through a screen. A bank balance appears in an app. A payment button sends funds across a network. A receipt confirms the transaction. The process feels direct, but the infrastructure behind it is layered, complex, and carefully managed. Every digital transaction travels through systems designed to verify identity, evaluate risk, and protect institutional stability. These systems include payment processors, clearing networks, compliance frameworks, and liquidity management protocols. At each step, the transaction must be accepted. The word approval is not symbolic. It is literal. Banks and financial institutions operate inside a highly regulated environment where the movement of money is constantly monitored. Anti-money laundering systems analyze transfers. Fraud detection algorithms track unusual patterns. Sanctions databases screen identities. These mechanisms exist to prevent financial crime and systemic instability. But their presence also reveals something deeper about how modern finance operates. Money inside the banking system is not a freely moving asset. It is a permissioned entry within a controlled network. This network functions efficiently because approvals are automated. Most transactions pass through instantly without human involvement. The approval process is invisible because the system rarely interrupts it. But invisibility does not mean absence. Every payment you make is evaluated. Every transfer is verified. Every account operates within rules designed to prioritize institutional stability. This structure becomes easier to understand when considering the nature of a bank deposit. A deposit may feel like stored money, but legally it is something else entirely. When funds are placed into a bank account, the bank becomes the owner of those funds. The depositor receives a claim against the bank equal to the value of the deposit. The balance visible in an account represents that claim. It is not a vault containing personal property. The bank is free to use deposited funds as part of its operations. Loans are issued. Securities are purchased. Liquidity is managed across markets. Deposits become liabilities supporting a broader financial structure. Under normal conditions, this arrangement works seamlessly. Withdrawals are processed immediately. Transfers occur instantly. The claim is honored without delay. But the claim exists inside a system governed by rules. Those rules define how and when the claim can be exercised. They also define when the claim may be temporarily restricted. In most situations, these rules remain invisible because the financial system operates under conditions of confidence. Depositors trust banks. Banks trust markets. Markets trust central banks. Confidence allows the system to function smoothly. Yet, the system itself is designed with safeguards for moments when confidence weakens. These safeguards often involve control over financial flows. A transaction may be paused for review. A withdrawal may require additional verification. An account may be temporarily restricted while compliance checks are completed. Each intervention appears small in isolation. But together, they reveal a fundamental principle of modern finance. Access to money requires authorization. This principle has become more pronounced as financial systems have become increasingly digital. In earlier decades, physical cash provided a form of financial autonomy. A banknote could move from one person to another without institutional approval. No payment processor evaluated the transaction. Cash moved freely because it existed outside digital networks. Today, cash plays a much smaller role in everyday economic activity. Most payments occur electronically through bank transfers, card networks, or mobile payment platforms. These systems rely on centralized infrastructure, and centralized infrastructure requires control. Payment networks must coordinate transactions between banks, ensure settlement between institutions, and manage liquidity across multiple financial layers. To accomplish this, they rely on authorization mechanisms. When a card payment occurs, the request travels through several systems before approval is granted. The merchant's payment processor sends the request through card networks to the issuing bank. The bank evaluates the transaction, checks available balance, and verifies risk signals. If the transaction meets the criteria, approval is granted. If not, the transaction is declined. The decision happens within seconds, but the principle remains. Money moves only after authorization. Same logic applies to bank transfers. A digital transfer between accounts appears simple from the user's perspective. Yet behind the scenes, multiple institutions may participate in clearing and settlement. Each institution evaluates the transaction within its own compliance framework. If a transfer triggers regulatory concerns, it can be paused. The funds remain recorded, but they do not move. This ability to pause transactions is not an accidental feature of modern banking. It is a central component of how financial systems manage risk. Financial institutions operate in environments where exposure to fraud, regulatory violations, and systemic instability must be carefully controlled. The ability to approve or deny transactions allows institutions to maintain oversight. Without this control, the financial system would be vulnerable to abuse and instability. But the presence of this control also creates a subtle asymmetry. Individuals see their money as personal property. Institutions see deposits as liabilities within a risk-managed system. This difference in perspective becomes visible when access is interrupted. When a transaction is declined, the immediate explanation may be technical or procedural. A fraud alert, a compliance review, a temporary system check. Yet the underlying reality is simpler. The system has exercised its authority, approval has been withheld. The balance remains, but control has shifted. This dynamic becomes even more significant during periods of financial stress. Banking systems are built around liquidity management. Banks must maintain sufficient liquid assets to meet withdrawal demands and settlement obligations. If large volumes of funds move rapidly through the system, liquidity pressures can emerge. To manage this risk, financial institutions maintain internal controls that regulate large transfers and unusual account activity. During periods of economic uncertainty, these controls may become more restrictive. Limits may tighten. Verification procedures may increase. Transfers may take longer to process. These adjustments are rarely announced publicly. They appear quietly through procedural changes. A transaction that once cleared instantly now requires review. A withdrawal that once required no verification now triggers confirmation. The system has not collapsed, but its rules have tightened. This tightening reflects a deeper principle of financial architecture. Stability is the system's primary objective. Access is secondary. If preserving institutional stability requires restricting financial flows, the system will prioritize stability. Most of the time, this priority remains invisible because the system operates under normal conditions. Payments move smoothly. Balances remain accessible. Confidence persists. Yet the underlying structure does not change. Every digital balance exists within a framework designed to intervene when necessary. The authority to intervene is embedded in regulation, technology, and institutional practice. It exists long before it is exercised. Over time, technological advances have expanded this authority. Modern financial institutions analyze vast amounts of transaction data. Machine learning systems detect patterns indicating potential fraud or regulatory risk. Payment networks coordinate with international compliance databases. These systems allow institutions to identify and stop suspicious transactions within milliseconds. The efficiency of this oversight improves security. But it also reinforces the idea that money inside the banking system operates under supervision. Supervision implies discretion. Discretion implies control. Control implies that approval can be withdrawn. This reality is rarely acknowledged because most transactions are approved. Approval becomes routine. Routine creates the illusion of permanence. But routine is not a guarantee. It is simply the system functioning as expected. The deeper question is not whether approval exists. It is who controls it. In modern finance, approval is determined by institutions whose primary responsibility is maintaining systemic stability. Banks, regulators, payment networks, and central banks collectively shape the rules governing financial access. Individuals participate within those rules. The balance visible in an account reflects a claim within that structure. As long as the system remains stable, the claim is honored without interruption. Yet the authority to pause, review, or deny transactions remains embedded within the architecture. This authority is rarely exercised dramatically. More often, it appears as small procedural moments: a delayed transfer, a declined payment, a request for verification. Each moment feels temporary, yet each moment reveals the same underlying structure. Money inside the banking system is not simply possessed. It is administered. This recognition does not imply that the system is failing. It reveals how the system is designed. Financial infrastructure exists to manage risk at scale. In order to maintain stability across millions of accounts and transactions, institutions require mechanisms that allow them to intervene when necessary. Those mechanisms operate quietly. They remain invisible during normal conditions, but they are always present. And when they appear, they reveal something that routine transactions often conceal. Approval was never permanent. It was simply continuous, until the moment the system decides otherwise. Approved, for now.